4 topics today. Really, one that's going to be how the market's moving, some of the volatility that we've all experienced, right? If you looked at your account April 4th versus today, it's a very big difference, right? Versus February 25th, right? So we've had quite a bit of volatility really to start this year. So that'll be topic 1. The second topic will be a little bit about why we're having some of this volatility. That's really going to be mostly around tariffs, right? The third topic will be some of the other reason we're having this volatility around interest rates, right? And what the Fed is doing. And then the fourth topic will really be about some of the international opportunities that are out there that may not necessarily be as real as they may seem on the headline, but they're getting a lot of attention because that's the area of the market that's working right now. So maybe I'll get going there, and please, like I said, ask away any questions. So this first slide here is really just highlighting market returns. I'll see if I can get the whole thing on here. Right, so what I tried to do here is really have 3 different categories across time periods, right? So we've got 2024 returns here. As we all know, it was a very strong year. Most specifically within domestic markets, specifically talking about the S&P 500, the Russell 3000, Russell 3000 growth. Really large cap domestic companies had a phenomenal year in 2024, not to mention a phenomenal year in 2023, right? But other areas of the market really did not participate, right? So if you look down this list, MSCI All Country World, which is really an international market, was really only up 5%. Emerging markets were up 7%. The value index was up 13, which traditionally speaking, I think most of you in this room 10 years ago, if you said, I had a 13% return, that's phenomenal, right? We're all very excited. We're used to 7, 8, 9% returns on average, but we've kind of gotten acclimated, right? The short-term bias of the human brain thinks now 20 and 25% is normal, right? That's kind of what we're expecting. When realistically, when you do wealth planning, whether it's the Brophy team or on your own, right, you're typically budgeting in a 7 to 9% return on the equity market, right? And we want to continue to do that because that's ultimately where we think we're going to end up breaking even on long-term returns. The next 2 columns over are really highlighting first quarter 2025 returns and then year to date. So this goes through June 25th, okay? So really yesterday's close. What I want to highlight here is the drastic difference of returns at the end of the first quarter versus June 25th, right? So really, you can kind of see the S&P 500 year to date through June 25th is up about 4%. The reason we have this second line item underneath the S&P 500, and you guys may or may not know this, the S&P 500 is a market cap weighted index. What does that mean? That means that the largest companies within those 500 have a significantly larger allocation and impact to that index. So Apple, being one of the largest companies in the country, right, on the S&P 500, has a 7% allocation. Microsoft, same thing, 6 or 7% allocation. NVIDIA, Tesla, Meta, Google, all the companies that we all know and love make up a significant portion of the S&P 500. Historically speaking, the S&P 500 has been an easy diversification tool, right? You own the S&P 500, you're owning a broad swath of the largest 500 domestic companies. Now about 40% of those 500 companies are concentrated in just 10 companies, right? So the reason we put the S&P 500 equal weight is to really show how the broader market is doing, right? So what the equal weight does, it makes Apple, Microsoft, and the 490th company all the same weight, so you can see what the whole market is doing as a whole rather than really specifically that mega cap technology bucket, right? So you can kind of see it really lagged in 2024 versus the S&P 500 and continues to do so this year because really there's so much momentum and demand, as we all know, before I start using a buzzword, AI and generative AI and technology, right? There is so much demand flowing and momentum flowing into these sectors that it's continuing to kind of rise and really create, we'll get to some issues with valuations, et cetera, but it's something that we want to flag and continue to put on this chart here. One thing I want to highlight before I move on from this is that international, if you guys look at year to date, is up 16% year to date. Emerging markets are up 14% year to date, right? So there's a lot of headline news that go international, this is where we should be, right? Just don't forget the last 10 years, they've lagged significantly, right? And that some of this is really people saying, I'm going to go try to find some lower valuation places to hide during this volatility, right? It's really hard to say, I'm going to keep buying more Microsoft, more Apple, more NVIDIA when valuations are this high. So when people get nervous, when the market gets a little kind of unsteady, right, people tend to flee to lower valuations because, right, there's much less downside for the most part if you kind of study it. So that's why international is really working, but over the last decade, which we'll get to, it's really lagged. So I'll move on to the next slide here. Sorry, I'm going to be moving around a little bit. So this slide here, let me zoom out a little bit. This highlights the move that we have seen since quote-unquote Liberation Day, right? So we have seen a 21% move in the S&P 500 and a 16.5% move in the MSCI All Country World Index, right? That, and for those of you that don't know, that weren't watching the market as closely as I was, all right, we're going to get on to another slide here. This slide right here shows the daily distribution returns for the S&P 500 dating back to 1970. So what this shows is that the majority of our returns on a daily basis are between 1% to -1% to +1%. In the month of April, we had the 4 largest distributions over the last 5 decades, right? So around Liberation Day, right? So April 3rd, we were down about 5%. April 4th, we were down about 6%, right? And then on April 9th, if you guys watched the market, actually this is a funny story, I was on with Tom Wilson, who some of you may know, one of my partners, and the market was down 4.5%. And it was about 10 a.m., I was out in California visiting a client, we were on a phone call, and he calls me, he goes, I'm pulling my hair out. I can't take it, this is really getting stressful. And we're on this phone call for about 20 minutes, and at the end of the phone call, I go, something's happening, look at your screen. We went from down 4.5 to up 3, up 4, up 5, up 6, all within 30 seconds. So within 18 minutes, the market went from down 14 to up 9, right? So we're not going to talk about this today because I think you guys already know this, but that's the danger of market timing. Trying to get out, trying to get back in. As Warren Buffett says, it's like winning the lottery, trying to buy at the right time. Now imagine trying to sell at the right time and try to get back in at the right time. It's like winning the lottery twice, right? And that shows that within 12 minutes, we had about a 12% market turn, right? Which is very difficult in regards to market timing. So if I go on to the next slide here, this is an interesting slide. So what this slide shows is that historically speaking, Black Monday in 1987, GFC really in 2008, COVID-19, tariffs, whenever we had this bad of a 2-day move, historically speaking, if you look out a year later, we've had some pretty significant comebacks in returns, right? And we've already experienced that this year. So, right, that slot down there under 1 month later for tariffs, it would be plus 17% right now, right? It's not filled in because the chart's really from April, but historically speaking, the patient investor, I'm not going to harp on that too much because I know you guys are all great at that, it pays off to stay invested, right, and not try to time it on the upside and the downside. But historically speaking, right, we put this chart in here to say that it's not abnormal to have these levels of returns when the human psyche and really the macroeconomists out there start to get a little volatile in regards to what's going on in the macroeconomic environment. Now let's get to everyone's favorite topic. Okay, so what we did here, this is really the president's agenda around why we're putting tariffs in place, right? This can be argued in each direction. This is simply just stating the 5 outlined facts that he put in place in regards to why we're putting tariffs out there, right? So one, negotiating tool, I think this is one that clearly came into play around Liberation Day. Basically, he said, I'm going to attack everyone at the same exact time, and then I'm going to pull back, right? That's exactly what he did. He obviously didn't say anything to anyone. That was the whole point. It was supposed to be a surprise attack, right? Second part is leveling the playing field. This is one where if you look at macroeconomists across the street, everyone would agree to this, right? Whether you're left side, right side, middle, we do need to level the playing field. It's really something that, quite frankly, we've been in a deficit for so long and we continue to increase that deficit, and there really hasn't been any action to help reverse that. How you approach leveling the playing field is a little bit of a debated topic, whether you attack everyone at once, including your allies and your enemies all at once. But in general, I think leveling the playing field is something that we all agree to. And I think that's something that, whether the course of action is appropriate or not, it needs to happen, right, long term. Otherwise, the US debt will continue to rise and we're going to start having some significant issues, whether it's 2 years from now, 5 years from now, or 10 years from now. The third point is promote greater national security. I think we all know this one. Reshore manufacturing. This is a topic we've been talking about for quite some time once we found out that the current president was rerunning, right? That there's going to be quite a bit of manufacturing that we want to bring back to the United States. Right now, this can be debated once again. The CEO of Nautica creates beach chairs, right? He was on CNBC, we interviewed with him, and he said, look, I make these beach chairs and I sell them for $25. Every single one of them is hand knit, okay? And I pay those guys about 15 cents on the dollar. If I bring that to the US, I can't find anyone to do it for under $10 an hour. So now that chair is not gonna be 25, it's gonna be 75, if I even wanna sell that chair, right? So there's some, obviously this is a heavily debated topic. I think it's healthy to reshore some of our manufacturing. I think what's even healthier is to start outshoring some of our domestic products, right? So by way of example, right, look at South Korea, North Korea, right? They don't have a single US manufactured car there because they're not allowed, right? Same with Japan, right? But yet we have a ton of Nissans, a ton of Kias here, right, that are manufactured there. We allow them in. They don't allow a single one there, right? So that's part of the negotiation tactic that's really happening. And the last point is obviously raising revenue to be able to afford some of the 2017 tax cuts and really start eating into some of that tax deficit that we built. So I'll get on to that next point here. So based on current tariff rates, right, back to April 8th, the day before we canceled, right, it really put the 90-day pause, it was going to be an average of 30% across every single import, okay? We are now at about 15% in regards to that 90-day pause, right? So really, if you pay attention to where the tariff kind of arrangements have been, we're really 10% across every import, and then some countries have 30 or 60%, such as Canada and China and some of the other countries that we know. This next slide really highlights something that's pretty critical in regards to that last bullet point of the tariff revenue. We're currently generating about $300 billion in tariff revenue, right? At this rate, if we don't increase or decrease, that's $300 positive dollars that are going to help pay off some of our deficit, right? Which we all know is in the trillions. So it's going to take some time. If July 9th comes around, that's the expiration of the 90-day pause, we're going to see about $150 million in extra tariff revenue if it all goes back up to that 30% level, right? So this is heavily debated across macroeconomists, especially in our industry, whether or not we're going to come up to this level. It changes by the second, it feels like. This morning I boarded a plane to come here, and there was a headline about China negotiations. Well, I spent 3 hours on the plane trying to figure it out. There's not a single note about what those negotiations are. So we can wake up tomorrow morning, I can leave here today, and there's probably going to be a headline, but I think that's something that unfortunately we just kind of have to hope and pray for. Any questions there so far on tariffs or some of the volatility before I move on?
Well, raising that money is just a tax.
I think I have to keep talking, otherwise it's gonna. Go ahead, continue.
It's just a tax.
Correct.
And when you have 70% of our economy is small business.
Yep.
And I'm one of those.
Yep.
It's killing us.
Correct.
So it's great to raise $300 million.
Yep.
It's bad that you're taxing the hell out of small business.
Correct. Correct. And I think I think I was talking to someone earlier here today, right? That's the flip side of the coin, right? Is that it's really going to hurt American small businesses that don't have right? Walmart's fine, right? Walmart has significant, correct. They have significant pricing power, right? Where they can say, okay, you don't want to keep that price, we'll go elsewhere. We'll go to another country, right? We'll go to another continent if we need to. We're going to find a supplier to make it at that cost. Not to mention they can eat that cost, right? So I was giving an example earlier about Levi's, right? I think I was talking to you, Pam, right, about Levi's. At the end of the day, when this whole tariff negotiation came to the forefront, right, we did a ton of analysis about what this is going to do to the American inflation rate, right? Levi's in general, before those jeans get purchased by you, they have to go through 4 different kind of, call it levels, right? The manufacturer, the raw material manufacturer is going to eat some of that cost. Then the distributor is going to eat some of that cost. Now the purchaser is going to eat some of that cost. And now whoever is selling it to you, Levi's, is going to eat some of that cost. So the American consumer, there was a lot of worries about inflation spiking back up to 5, 6, 7% because these corporations are going to continue to pass along these costs. We don't think that's the case, especially in a lot of these larger businesses. Small businesses, they have to be able to survive, but because of, I don't have a slide in here, there's something that we monitor very closely called Consumer Fear Index. Okay, it's run by the University of Michigan. The Consumer Fear Index is essentially a survey that gets done on a monthly basis that shows how comfortable consumers are, American consumers are, in our current economy, in our current environment. When this spikes, there's almost always a correlation into how much they are spending, right? Because when you're afraid of what's going on in the market, you're kind of strapping your belts, right? You're not spending as much. Well, right now, Consumer Fear Index is very high, right? So that's actually protecting our inflation. Because Walmart, go ahead and increase that price by 15%. I'm not going to buy it because now I'm afraid what's going on in the market, and I'm going to take a breather and maybe go buy the white label product. Yeah.
Throw in one more comment.
Yep. Keep tapping this thing.
Small business, not Walmart.
Yep.
The tariffs prevent us from being able to reorder our stock.
Correct.
Cash flow.
Yes.
So we can't afford to pay the tariffs because we get it back.
Yep.
One sale at a time, right? So we got to pay the tariffs all up front before it's delivered to my facility.
Yes.
But I get it back one sale at a time. We don't have the kind of cash flow to do that.
Correct.
So if they restructured how we pay tariffs, to say we pay it on profit and loss statements or something on a quarterly basis, it'd be way more easier for small business to survive.
Yep.
Because we got to front this money, and no bank will loan us the money to front the money, we'll just go out of business.
Correct. Correct. Yeah.
But also, I mean, I just don't get it. I understand, manufacturing is much cheaper in China. They can do it a lot better than us.
Yep.
For the usual,
No
common
question, no question.
Mm-hmm.
common things, right? But we are doing so much in services. So I think people are looking at both sides of this point, right? They're just going, well, they're not buying enough, whatever, widgets from us.
Yes.
So let's force them to, we'll tariff the heck out of widgets.
Yep.
What about all Meta and
Correct.
Twitter and Instagram
Yep.
and all of these services that we have? And these guys are raking in billions of dollars. That's why we're all making
Yep.
the returns we're making.
Correct.
So nobody's looking at that side of the coin?
No, so they are. So I think that's a misconception in general in regards to the U.S. economy. 65% of the U.S. economy is driven by services.
Yep.
Okay, so in general, we are. That's why the current president can go out there and threaten such tariffs, right, on goods, because he knows that 65 to 70% of our economy is driven by services, right? And quite frankly, we have the highest margin services, right? Like you just said, Meta, Amazon, Google are our highest margin businesses. They're all U.S. domiciled, right? None of those companies are China domiciled or India domiciled, right? Wherever they may be. We have very high margin businesses here in the U.S. that everyone relies on, which is why he has this firepower. In regards to small business, that's the risk, right? That's the risk that's happening right now, and that's why there's so much debate about it, is that the American dream comes from small businesses, right? And as a president that holds their head high on the American dream, right, some people are feeling like it's not being taken into consideration. So that's kind of where we're back to that initial kind of bullet point list that we had. There's a lot of hope out there that this is all a negotiation tool, right? Is that the goal is to go out there, really threaten as much as we can, and then pull the rug under and come out stronger on our end. We'll see. Now, there is an argument to be made that small businesses might do better longer term because of the onshoring and reshoring. There is a, if they survive, correct. And what can help them survive is actually the Fed, right? And the Fed has a lot of control right now because, to your point, in order for you to go buy that inventory, you might need to take a loan. That loan is still costing you a boatload, right?
Which is adding to my tariff costs.
Correct. To your cumulative, right? It's ultimately affecting your margin.
My consumers.
Correct. Which ultimately you're going to have to pass on and hope that the consumer is willing to take that, right? And if they're not willing to take that, it's going to impact you. But if they do take it, it's going to impact inflation. So that's kind of where we are in this middle ground area, and that's why there's so much debate about it. That's why inflation came out today at 2.7%, core inflation. That's a little higher than we all expected, right? We were expecting around 2.4 to 2.5 in regards to the macroeconomic environment, came out at 2.7. Well, that came out at the same exact time that there was a China headline that we're making a trade deal with them, right? So if that trade deadline or deal did not come out as a headline, I'm not a gambling man, but I would bet the markets were down today, right? But because that headline came in, people are looking forward and thinking, okay, there's a chance that this inflation will now start to cool again. Yeah.
hoping that you take these things into account. Well, I think what is forcing in at least my part of the work, which is not very big, right? It's very very narrow. Is forcing people to figure out how to manufacture. We make equipment that is $5 and $10 million.
Yep.
Right? If we had to pay tariffs to bring all of this here, build it, and then ship it out, we are not going to do that. We are actually going to offshore all of
Correct.
it because some of the parts actually come from somewhere else.
Correct.
So there is no reason to actually bring it here, build it here, and then ship it to the Far East. We can just build it in the Far East.
Yep.
So unfortunately, well, it's good for us. It gave us a wake-up call.
Yeah.
We should have done this thing a decade ago.
Yeah.
We just didn't do it because we thought it just makes sense, right?
Yeah.
MIT is right here, Harvard is right here, all the schools are right here. We'll just bring all the people here to build that $10 million piece of tool, right?
Mm-hmm. Yeah.
Now, we're not.
Yeah. No, it's good. It's a good concern. I think that's
Plus, it's not coming back.
correct. I think, and that's part of the debate. If you watch CNBC, if you see small business owners go on there, right? That's the debate they make on a daily basis, right? It's kind of small business versus big business right now. Who's going to be able to benefit? Who's going to be able to survive, right? Any other questions on that point before I move on? Okay. I don't know what's going on out there, but there's a bear on the golf course. Okay, so this is the last slide here on tariffs that once again, this is very stale. Even though it's as of June 24th, it's already stale, right? Because there's conversations that have happened this last night with China, actually Canada. Trump just said he decided to cancel all the trade deals with Canada about 2 hours ago. So I won't really spend too much time on this because this is literally changing minute by minute basis. Okay, now let's touch on the third point here, and that's Fed funds rate. As we all know, as a small business owner, as anyone that has a mortgage that's recent or bought a new car, interest rates are still pretty high, right? They're probably higher than we all would have expected. We all were probably expecting a cut, call it 6 to 12 months ago. We're still in this relatively high interest rate environment. The Fed spoke earlier this week. What they said is they're going to wait for one more inflation reading, right? And we're going to have to monitor that pretty closely. But I think in general, the consensus, this slide has a lot of numbers, a lot of squares. The consensus is the Fed is going to continue lower this year. It's no longer for 6 to 8 cuts this year, it's for 1 to 2 cuts this year, right? And then for 3 or 4 next year, when really consensus was 6 to 8 this year and 4 to 6 next year, right? So in general, the theme is the Fed will stay higher for longer because of the uncertainty that we're in. Now we're going to have to continue to monitor. I don't have a slide in here on inflation, but that's really going to be their primary gauge here. In general, once again, the Fed has two objectives, right? That's full employment and keep inflation at a pretty neutral rate, and that's about 2 to 2.25%. Employment is very healthy. It's still very difficult to find jobs out there. We are very much so fully employed in regards to a healthy employment level, which gives them this firepower to stay higher for longer and continue to fight this inflation, which currently came in at 2.4%. They're being pretty persistent and want to bring that down to 2. This next slide here, just talking about the yield curve, we've come a long way. I think for some of you that attended this last year and the year before, right? I think we did casino and then we did a country club event. You would have seen a very inverted yield curve like you did on July 3rd, 2023, right? Where you were getting 5.5% on a 3-month and a 1 year, while you were getting 3.7 on a 10-year. That's a very unhealthy yield curve environment, right? We have now corrected pretty significantly. The short end is still a little higher, but basically you're getting the same that you're getting on a 6-month versus a 10-year. And because obviously we all anticipate the Fed to cut, a lot of people are now extending duration in their portfolio. So that's something that we're actively doing. If any of you are clients of William Blair, you've probably seen us as bonds are maturing, right? We've been extending that duration, locking in some of these yields, locking in 5 to 5.5% on some of our corporate bonds, and really kind of laddering out that structure to reduce the federal interest rate risk on the municipal bond and corporate bond portfolios. Any questions on that before I move on to the last segment, and then we can take broader questions? All good? Okay, The last part we're going to touch on is what do we think about the international market? Taking a step back, as I mentioned at the outset, there are very different dynamics. And quite frankly, in the current uncertain environment that we're in, tariffs impact international markets quite a bit more than they do domestic markets. Why is that? Domestic markets are 65% driven by services, right? They are significantly more driven by goods than we are because of what you guys mentioned, Meta, Amazon, Google, right? All our tech companies are a significant portion of our high margin profitability here in the States. So when we think about the opportunity internationally, right? So this is one of our typical portfolios. Let me see if I can scroll down here. What I did here is I put all of our sectors on here, and what we look at for international exposure is actually the revenue of the company versus the domiciliation, right? We don't care if you're domiciled here, India, China, Taiwan, wherever it may be. It's really who and where you're deriving your revenue from, right? Coca-Cola is a U.S. company, right? They're one of the staple U.S. companies, right? Only 44% of their revenue comes from the U.S. That's a global company that has international diversification, international exposure. So that's what we look at really is that revenue. You can see here in essentially every single sector, we are still favoring the Americas, right? And that's intentional. Now, there are certain sectors such as energy where we have a little bit more Asia Pacific exposure. In IT, we have a little bit more Asia Pacific and Middle East exposure. We have very little, I should say, to Middle East and Africa, but we have relatively underweight exposure to Europe, right? So we continue to favor the Americas. I think one of the reasons that we're going to get to on this next slide is that a lot of this headline international is the place to be is pretty fictitious, right? So this left-hand side here, let's use Germany as an index for Europe. That's typically what we do kind of in the macro side. We kind of monitor Germany. Yes, the public investment year-over-year growth is spectacular, right? That's because of defense spend, right? Because of the environment we're in right now, because of the macroeconomic uncertainties that we're going through and the geopolitical uncertainties we're going through, every other country, including ourselves, is spending quite a bit on defense, right? So it's making a pretty fictitious year-over-year growth in spend, right? And typically we monitor spend to be able to tell how the environment is doing and how the GDP growth is going to be. If you take away government spend and look at Germany year-over-year growth, it's actually negative in essentially every single sector except for construction, right? So in general, Europe is still struggling, but if you look at CNBC, if you look at Yahoo News or whatever you follow, it's going to say Europe is booming, right? They're having year-over-year growth versus the US. Yes, on the government side, right? Ex-government, it's actually not taking place as much, so we fear that some of this is fictitious, and while we think that some of this growth that we've seen and outperformance that we've seen in international markets has been great because they need to catch up. It's been 10 years of lagging. I think I might have that slide here. Yeah, this is a good slide here. So this is the S&P 500 versus the Euro Stoxx 50, right? That's over the last decade. S&P has grown at 10.9% annualized rate, CAGR, versus the Euro Stoxx 50 at 4.5%. Right, there's some catch-up to do, but we still don't necessarily see an institutional reason to be converting more towards Europe and international markets. Do we like them for the valuation argument? We do. We don't necessarily like them as much for the fundamental growth algorithm. And as at William Blair, I think most of you guys know this, you've heard me speak before, we're fundamental investors. We think that there's a very high correlation with the earnings growth of a company and their stock price. There's quantifiably a 92% correlation. So if you look at the reason Microsoft has gone up and to the right, Apple up and to the right, Google up and to the right is because their earnings are growing up and to the right, right? And if you overlay their earnings growth with their stock price, it is very, very tight-knit, right? There's a reason, you guys have heard me say this before, GM and Ford do this. The stock price is exactly where it was 20 years ago. If you timed it right in that period, you might have made some money, but you're exactly where you were 20 years ago. Right, so what we believe on the fundamental side is find a company that's going to grow, continue to grow earnings up and to the right, and the stock price will follow. Yes, there's going to be some valuation volatility that happens in between there because you're owning a growing company, but ultimately you're going to be happy you own them 5, 10, 15 years from now. And I think that's all my prepared remarks.